we are going to hear from our capstone panel. So this has been a feature of the conference since our very first year, and it's an opportunity for us to continue adding to we've talked about just the differing perspectives that are infused throughout this conference. And we are going to hear from three community bankers who are going to discuss the future of the community bank business model. But that's all I'm going to say about that, because I am going to turn everything over to the incredibly capable and interesting Brian Sullivan at the FDIC. He's in the Office of Communications, and he is also the host of the FDIC podcast. Brian, all to you.
Jim, thank you for that bit of irrational exuberance. It's great to be back at this conference to have another conversation about the future. In years past, we've talked about the future of commercial real estate and the future of relationship lending in this digital age of ours. And after last year's bank turmoil, we asked what future success in community banking might even look like in 2024 and beyond. And so today we thought we'd just continue this theme and explore the very future of the community bank business model itself. And so joining us are three community bankers who will share their unique insights about their own business models. And so let me introduce them to you. Shaza Anderson is founder and CEO of TrustStar Bank in Great Falls, Virginia, just outside of Washington, D.C., a privately held de novo in 2019 that was formed. Now has 5 branch locations, 60 employees, and total assets of about $1 billion. Billy Carroll is the President and Chief Executive of Smart Bank, based in Pigeon Forge, Tennessee, a bank born in 2007. Smart Bank now boasts 42 branches spread across Tennessee, Alabama, and Florida. And you've grown your business now to very nearly 600 employees and nearly $5 billion in total assets. And finally, Tom Levitt, President and CEO of Northfield Savings Bank in Northfield, Vermont, a mutual savings bank that was founded way back in 1867. And throughout this long history, Northfield Savings has remained, it loves to brag this way, fiercely independent. It's never been acquired, nor has it acquired anybody else. It has 14 branch locations focused right there in central Vermont, and total assets just north of $1.5 billion. So welcome to you all. Thank you for having this conversation. And let me invite each of you to tell us a little bit more about your bank and your particular business model, and then we'll take it from there. And Shaza, let's begin with you.
Well, thank you so much for having me. It's so great to meet all of you, and thank you for attending this conference. I'm going to say that banking has been, I guess, in my blood for so long. I'm a serial banker. This is the second bank that I have started. I started one before that called Washington First Bank, which we ultimately grew to about $2.1 billion, and we sold it. Once we sold it, I realized that there was a vacancy in our marketplace. The Washington, D.C. market is very vibrant. There was a vacancy in that marketplace because a lot of us small banks had been offered offers we couldn't refuse, and you know, a lot of the small banks were acquired, which left the community in need of your community banker. So I decided to start TrustStar Bank, brought the team back together, and we opened our doors in 2019 and hit the ground running. I think our business in the Washington, D.C. area is really twofold. It's real estate and it's government. It's companies that you know, are government contractors or work with government contractors. So our niche is really slim, if you call it. We don't have agriculture, we don't have manufacturing, we don't have any of those types of services around us. So our niche is limited, but having said that, we've been in the market for a long time, and these customers are in need. And we could have a conversation about real estate at a later time. But with that, I think I could turn it over to Tom.
Yeah, well, Tom, your bank's been around for more than 150 years. I have to imagine the business model at your bank has changed a little.
I haven't been here for all of them. It just looks like half, perhaps. But I have had the privilege and the joy of serving as CEO for the last decade, and we have been able to double the assets over that period of time with a great team. Sticking close to home in central Vermont, which is the home of our state capital, Montpelier. And it is an organization that for the first 100 years really centered all around the community of Northfield, Vermont. Northfield, Vermont is the home to 205-year-old Norwich University, the nation's oldest private military college. And it was founded in that year that you mentioned, back just after the Civil War, by Reverend Edward Bournes, who was a Norwich president himself. So very focused on the local community for the first century, around common folks that made the place go, taking care of their deposits, making sure they were set up in homesteads and in their merchant activity, their enterprises. And then branched out into central Vermont, and just over the last 2 decades in the Burlington area where I'm from, in Chittenden County, our only MSA in the state of Vermont. We have 647,000 souls all in. So we have managed through attrition to become the largest bank headquartered in Vermont, but certainly not the largest by history or legacy. So the last decade, the model has shifted significantly. My predecessor, Tom Pelletier, began this transformation from a solid consumer-oriented mutual savings bank with a cuddly pig as a mascot to more of a commercial leaning enterprise, and then we took it to the next level. And for the last 5 to 6 years, our strategic plans have successfully moved harder towards enterprise, government, commercial, and we've been able to compete with what we call the legacy banks, the larger banks that were formerly headquartered in Burlington and in Vermont. So that's going well. It's methodical, but our commercial footings now exceed our residential footings for the first time over the past year.
Billy, how about your bank?
Yeah, as you mentioned, Brian, de novoed the bank in 2007. Kind of like Shaza, it's kind of what I knew. I grew up in the banking business. My father helped found a bank in the Sevier County, the Pigeon Forge, Gatlinburg area there at the base of the Great Smoky Mountain National Park back in the early 70s. And I grew up in that bank, and after a short stint as a CPA after I graduated college, I had an opportunity to come back and work with him, and had an opportunity to do that for about 13 years. And I just had a little entrepreneurial bug and wanted to start something on my own. He agreed. He was ready to retire, but still had a little bit of juice in the tank, and so he decided to help me do this, and we started Smart Bank in 2007. Really with a kind of with a premise to grow, not just in our community, but a little more regionally. And we had a lot of great support from a great team. Grew organically. End up 08 and 09. You think about starting in 07. You think, gosh, what a tough time to start a bank. But it really, we're really fortunate. Timing was good for us because our balance sheet was clean. We had plenty of capital and didn't have any problem loans. And so we were able to navigate that and got a chance to play offense in 9, 10, and 11 where everybody else was playing defense. And so it allowed us to really scale quickly, did an FDIC acquisition in 2012 that in Florida, we've got a very entrepreneurial board, and so we were looking for opportunities to expand, grew into Florida, and then after that did 6 other acquisitions that allowed us to really form some scale and get our bank up to about $3 to $4 billion in assets. once we did that, we shifted a little bit in the last few years as we've gotten some size to us with a little more of a lift-out model, taking advantage of some disruption with some larger banks and really pulling some good teams together in some of our markets in Tennessee, Alabama, and the Panhandle of Florida to start growing organically. So we're a little bit of a mix. We've got some really great retail business through the community banks that have become part of our company over the last several years. But then also we're in some larger MSAs now, and some tier 1, tier 2 MSAs with some really good commercial banking teams. So we're primarily commercial, but still have a really nice retail deposit base and some offices and markets with a number of branches. So a little bit of both. We've got a couple of other ancillary business lines. We've got a really nice investments line of business. We're in the equipment finance business and in the insurance business as well. That things that have come, opportunities that have come our way over the last few years. So.
Well, they say community banking isn't really a monolith, and I think these three stories sort of prove the point here, that we all come in different shapes and sizes and histories. And, you know, Shaza becoming a de novo right before a pandemic, what were you thinking?
Who would have thought that we opened the bank and 6 months later the pandemic hit? No one predicted a pandemic. Having said that, we really just rolled up our sleeves and started doing all these PPP loans. I personally did them with the team. We had 11 employees, I think, and every single employee was doing PPP loans. I think we did the first week 350 loans. We used it as an opportunity, as sad to say that, you know, the pandemic affected all of us. It was an opportunity for us. All these customers that were planning to come to the bank ended up just coming to us sooner because we helped them with their PPP loan, and they moved all of their business to us. So I would say that I don't regret, you know, starting when I did. Having said that, you know, I think, and I'm sure, you know, a lot of you are community bankers in here, there's a huge need for community banking in every market. I think DC is just one of them, but there's a huge need, and if you open it, they will come.
Yeah. Well, last August, the Federal Reserve Bank in Kansas City published a report about the unique characteristics of and importance of community banks, and it told us what everybody here has been talking about during this conference and has known for quite some time. That despite all the shifts that have gone on in the banking industry, community banks remain a vital and source of reliable capital to their communities. And let's be honest, in some rural areas, if not for that community bank, there may not be a bank at all. And so, Billy, would that be true for some of the communities that you serve?
Yeah, absolutely, Brian. You know, it is, and we've talked about it. I've got a unique footprint because I'm in some really small rural markets in Tennessee and a couple in Alabama. Then again, we're in some metro markets. And to your point, as part of that, you know, as we've looked and we've grown both organically and via some mergers, we've got some phenomenal small markets, or some of my favorite markets in our entire company, that there might be just two banks in those markets. And you know, it was great. Liz did a great job this morning, and I was listening to, as she talked, kind of some of our stories paralleled a little bit in our companies, and we really are. We're $5 billion in assets, but still really a community bank. I think you can be a community bank whether you're 5, 10, maybe up to 20. At some point, it probably changes a little bit. But from our standpoint, really being able to participate and lend in to these smaller markets is crucial. Mm-hmm. And at some point, as banks go upstream, I really felt like some of these smaller markets could lose some of that opportunity. Right. So I think it's really important for the community bank model to continue to focus efforts in some of those zones.
Yeah, and Tom, does that all ring true to you too in your communities?
Oh, it absolutely rings true. What Director Clark shared with us yesterday about state chartered banks being down 1/3 just in the time this conference has been going since 2013. That's an alarming trend. And clearly what we have heard at this conference, whether it's been from President Musalem, whether it's been from Charlie Clark or President Milhorn, or whether it's been from Chairman Gruenberg or President Schmid, is that community banks matter. And our research that we've been listening to for these 2 days, just incredible academic rigor, points to some contrarian thoughts about community banks. And I think there's acknowledgement that some of these factors are very real statistically, but qualitatively, you remove a community bank from a rural community in northern New England or in the lower Appalachian or even in greater DC in certain communities, and you're going to feel it. And so hearing the commitment of the leadership of the Federal Reserve, the FDIC, and the Conference on State Bank Supervisors over the last 2 days has been very reassuring to me. So we're going to shoot for 175th birthday and maybe even 200.
Okay. Well, a shout out to my own agency, as we heard Chairman Gruenberg in his keynote yesterday point to this latest small business lending survey, which found the takeaway that I got from that is that when making small business loans, smaller banks, those banks with less than $10 billion in total assets, generally rely upon soft or difficult to quantify underwriting information in making their lending decisions. On the flip side, those larger banks, those with assets greater than $10 billion, rely more on those quantifiable yardsticks, like reports from credit bureaus. So let me ask each of you, does that sound like your bank, the kind of lending decisions and how you make them to your small businesses? We can begin with you, Billy.
Absolutely, and I think it is, as Tom talked about, seeing the number of banks go from, I know when we started, I think in 2007, I think there were 8,500 banks. Today there are 4,500. So you're almost half in just that short time span. And I think a lot of it goes back to, there's various reasons why you're seeing some of that consolidation, but a lot of it goes back to making sure that you can serve that community and still make a profit, and I do want to talk about that, because I don't think it's discussed enough that banks have to make a profit. The whole system is fundamentally based on raising private capital. If private capital has to have a return, and if private capital doesn't get a return, it's not available to us. And so I do think it's important. I wanted to make sure I discuss that first, and I'm going to answer your question, because going out and lending into our communities is critical, and we do. A lot of these softer, you say the softer components of who's who, that's there, but again, regulation sometimes get in the way. I'm scared to death of 1071. We've got 1071 staring us in the face. And we've seen what it's done to consumer lending in a lot of our banks, because the penalties in consumer lending are pretty challenging. That's the reason a lot of banks have gotten away from it. It's gone into other types of banks, credit unions and others. So I think, especially in the commercial business, we have to have the ability to have some discretion in that. And I think that's really important, because at the end of the day, we want to lend money. And so it's paramount that we're able to have some subjectivity in that, because it's not black and white in so many areas related to commercial lending in particular.
Mm-hmm.
I was compelled by Governor Bowman's remarks yesterday about that one size does not fit all, and this idea of segregating a community bank from a large bank. I think you got to move up the food chain a little bit and to talk about systemically important institutions, and what happened to those of us that were not in that small club during the fallout from what happened in March of 2023.
Yep.
Yeah.
So we were besieged by concerned depositors that were hearing signals from Washington and New York that we maybe would not be covered if an uninsured depositor, say with low 8-figure deposits with one of our banks, suddenly experienced a bank that was going into stress or even failure. So that really impacted the business model short term. I think long term, we've been able to come through that. The federal regulators certainly stepped up during that crisis last year and solved the immediate instability issue. So we had to kind of go along for the ride. But I do want to come back real quick, and you can skip over me after that. But I want to talk about the soft skills, because they've come up in this conference over and over again. That knowledge, that private knowledge, I think was another descriptor that some of the researchers call it. But when you come into our management loan committee or our board loan committee, as a lender, you better be prepared for these dirty dozen qualitative types of inquiries from senior leaders in the credit function, the CEO, and then the members of the board loan committee. But I'll just rattle them off for future research fodder, folks. So these are the 12 real quick. Anything that's been in the news is for starters. Reputation, it matters. Extent of other banking relationships, competitive environment and borrower's landscape, management depth, succession planning. Do they have a CFO? Do they have a controller? Do they have a bookkeeper? Do they have anybody paying attention? And who is that, and how long have they been there? Key man insurance, if it's just a one-man show, but it's a very important client. Level of regulation in that particular sector, concentration of customers and sources of revenue, ownership structure, transaction versus relationship. How will the betas that we heard about in this conference affect this particular new relationship we're looking to take on? Are they going to run the minute we start to adjust rates in an unfavorable way, up or down? Or are they going to hang out because of the relationships we heard other bankers like Mary Willis and Corey Neal and Elizabeth McGinnis earlier today talk about? So sorry for the epistle on that. Technology backbone stability, their cyber defenses, supply chain dependencies, industry climate. We subscribe to Vertical IQ, and we run every NAICS code that we have through that analysis to get global industry insight for that particular opportunity. And then finally, site visit reflections. On the ground, eyeball to eyeball, hand to hand, what have you learned? And if they're not good at answering those questions, guess what? The board loan committee is not going to see that credit, because management's going to say, go home and do your homework.
And Shaza, how about you?
I mean, I would say exactly what Tom just said. It's not a cookie cutter for us. We have to know who our customers are. And being in the market for a long time, we know all the people that we're really working with. I would say that the discretion that we have is more based on did this customer have experience, or do they not? Have they been in this market for a long time, or have they not? In addition to everything else that Tom just mentioned. You have to use judgment at the end of the day. The numbers could tell a story, and then your judgment could tell a different story. We've turned down loans that the numbers looked all right, but it didn't make sense. It didn't make sense. And sometimes when it doesn't make sense, you really have to question, why are they getting a loan?
So you all have guts that
Yes,
you trust.
we do.
Absolutely.
We do.
I think that's what makes a community bank special and different. It's not all about the data. Data is important, the financials are important. Obviously, there's some certain things that every deal needs to have. But at the end of the day, I think a lot of it, I think that's what makes the community banks different and special, is that they have an instinct. I mean, and I'm sure Tom and Shaza will say this, the number of small businesses that we have helped start because we had a gut feel that okay, this person has got a great idea. We need to help them. Did the numbers work? Yeah, it was pretty close, but you're taking some risk. But at the end of the day, I think your community bankers have a great gut instinct about really helping those businesses get started.
Well, if community banking is built on relationships and that gut, if you will, the human touch, how do you remain true to that when the entire banking landscape seems to be moving away from that? Or am I overstating the point?
I don't think we're ever going to go into a system that scores, you know, everybody's financials and then give you a score, you know, the score approves, the score declines. It's just not who we are. I don't think that any community bank in their right mind would just rely on that by itself. I think you could use it as a tool just like any other tool. But I think what makes us different is we listen to what the client's needs are and we tailor something that is right for them, as opposed to having it be in a box and you say you fit in that box or you don't fit, and it just doesn't make sense.
Mm-hmm. Tom?
I think they said that well.
Okay.
You move on to whatever you want.
Well, but I'll add too, and I'll go back again to Shaza's point. That's what scares me about 1071. If we're going to make commercial banking look like HMDA, and get criticized because our gut says I'm not comfortable making this loan to this individual, and you're going back to just looking at data, that could create some real problems.
Well, then let me ask this. Each of you have been in community banking for quite some time, and are the challenges confronting community banks writ large and your own institutions in particular something new today, or is it a variation on a theme? How are you adjusting? Because you have to be nimble, do you not?
I mean, I'll take that first and then we'll listen to my colleagues. I'm going to say that banking is so cyclical. Sometimes banks need loans, sometimes they need deposits, sometimes they need fee income. Well, what we're faced with right now, and everybody's faced with, is that cost of fund. And the research that you all did really brought that to light. It's cost of funds, which relates to the net interest margin. The rates went up so drastically, 13 or 14 times in a period of 18 months. Well, that affected every bank in the country, big or small. Having said that, I think that that what we really need to do is always look at what is the challenge and try and make the best decision at the time. The difference is we are nimble, we're small, we can make quick decisions that will help affect, you know, the outcome in the future. But net interest, the net interest margin, I think, has been a big problem for a lot of the banks, and we're navigating. It's not an overnight fix. Yep. We're navigating through that, but I'll listen to my colleagues.
Well, I haven't always been in banking, but the 31 years I have spent in this industry have been very gratifying, but I haven't seen any change as accelerated as what we've seen since 2019. In banking or potentially in the world. I don't want to be one of those. This is the most incredible period ever, but it's fast, it's media driven, we saw it last year with the flight of deposits from a previously solid institution. We have to be concerned about that. There was research in this conference about that. We've had the pandemic. We had to spin on a dime. Our institution performed 1,700 Paycheck Protection Program loans and $140 million in a relatively short period of time, front-loaded in 2020. To play that role, we had to fundamentally remake ourselves, and really thank you to the FDIC, the Federal Reserve, for the forbearance that you gave the banks during that period. The financial institution letters that we got, the guidance that said, you know, don't forget you're in a risk management business here, but you've got some customers hanging by a thread. Go take care of them, do what you got to do. We'll come back and settle up next exam, but we'll remember this, Phil. And so the same thing just happened with the flooding that we took this summer in Vermont, and it was even more devastating last summer, made national headlines for a couple days. I don't think it compares to what we've been seeing in Western Carolina, frankly, but it was rough. And so to get a fill just in the last week or two from the FDIC saying, okay, the president has declared emergency for your area, FEMA's coming, go ahead and again do what you have to do. It's a real partnership with the regulators that we're able to fully fulfill that mission.
Well, I was remiss. Billy, how are your banks? How are your customers?
Thank you. And I know Tom was talking about some of the issues. We had a lot, as everybody's seen in the news. I mean, we had some pretty rough stuff happening in the upper part of East Tennessee, just a little north of where our markets are, and then Western Carolina, just some tragic situations over there, and a lot of just beautiful little mountain towns that I'm sure a number of y'all have probably visited over the years, really in a bad way. But you know, we'll get through it. I know Air Banking Association, we're doing some things, raising some money. We've got some great bankers in that zone that are already trying to mobilize some plans to help. So we'll get through it. And a lot of it from a positive standpoint, I'll tell you who's going to step up and help in those situations. It's going to be our community banks. You know, and I think that's what's so awesome about our industry is when you have these types of situations, the people that step up first are the community bankers, and so they'll rebuild. It's going to take a while, but thank you for asking, Brian. But we'll get through it, and we'll do that. Following up on your question, I mean, yeah, absolutely, we've got headwinds in our industry, and as Tom said, it seems like we have a once-in-a-lifetime issue every year now, you know, and it's just like, my gosh, I mean, what's next? And so, but you know, these are things that, you know, bankers are resilient, especially community bankers, and we find ways to navigate through those things. So yeah, you know, obviously, you know, between technology is something that's coming at us, that's changing the landscape much faster than I think any of us anticipated. Just what tech looks like from 5 years ago to today is night and day. So, you know, we're looking at those things. You know, we've got talent. You know, not alone are there half the number of banks that there were 18 years ago, they're half the number of bankers. So I think we're all fighting for talent, and you know, and we've got to make banking sexy again. You know, I think we kind of our industry's got no disparaging any about our panelists up here, but you know, I know we go out and do a lot of recruiting, and college campuses have a great internship program. Liz, I think you mentioned that with your bank. We're doing some things to try to get out there and talk to people about what great things we're doing in this industry. So we can figure out ways around some of this stuff, but yeah, there are headwinds, but we'll figure out how to get around them.
You know, a lot's been said about deposit stability at this conference, and you mentioned, was mentioned here about last year's bank failures, and initially there was a lot of fear that there would be a flight of deposits away from the small banks to the big, deemed more systemically important banks. Mm-hmm. And in the end, if it happened at all, it was short-lived. And do you think that said something about customers' trust with bankers they know?
I think that whenever you have something that's disastrous that's happening, which is a failure of a bank, it scares people. And the most important thing to a person is their money. I mean, at the end of the day, you know, you have to protect your money, your assets. What I have found is that a lot of people did not know about the CDARS program and the ICS program. We had to do a lot of education during that time. We were lucky that we didn't lose any deposits because of the outgoing sort of discussions and communications with our customers to educate them about, you know, how they could keep their money safe and how they could sort of trust their small community bank. So it was a lot of work, but we didn't experience the runoff. But what I did realize is a lot of people get scared quickly. It's the media. Who mentioned the media?
Yeah, Tom.
Yeah, Tom.
No, it is, yeah.
It's the media that kind of starts bombarding people with information, and they get overwhelmed because they don't understand it.
Shaz, I'll add, and one of the things too, and again, media is so important. You go back to SVB, and I remember, sitting there and I've got CNBC on in my office, and they kept putting the, bank stock charts up there, and all of these guys out here looking to short banks to make money. That's a big issue because our system is built on trust. If we don't have trust, man, we've got some serious problems. And so I know just watching it, I would get so upset watching them just get out there and talk negatively about these banks and flash these star charts. Well, to Shaz's point, when normal customers are watching this and they're looking at this, they say, my gosh, that's my bank up here, and I'm looking at their stock price, they must be in trouble. Well, that bank wasn't in trouble. Right. It had plenty of capital, had plenty of liquidity, people were just shorting it.
Yeah, well, Tom, you don't have to worry about stock prices, but still, you all have to lean on your relationships. So you have found,
but it still impacts.
Yeah.
Well, we did, but there was a moment during this crisis where everything became transactional. Where personal or business or self-interest took over, and relationship kind of was competing on a sidetrack, and it really stemmed. March 7th, 2023, the chairman of the Federal Reserve was on the hot seat in Congress, doing his incredibly impeccable job of explaining the dual mandate and also signaling strongly. We were having a board education session while this was unfolding, and I was scrolling the live feed of his presentation. But the inflation had not been tamed. We were still in a tightening mode. We were going to stay on that track until we got down to target level or approaching that level before you could see any plateauing or let alone decline in interest rates. And I turned to our trustees and I said, our fate has just been sealed. We are going to be in this for a while. You all need to adjust to this squeeze of the net interest margin. You need to adjust to lower earnings and lower capital accumulation. We will get through it because of our strength, but this is the real deal. And it has unfolded accordingly. And then a little bit later, I think the same week or early next week, Treasury Secretary was being drilled about systemically important institutions and what was being done to cover the depositors, the uninsured depositors of the failed institutions. Well, there was no mention of whether that would be extended to high seven-figure and maybe low eight-figure depositors in community banks. And we had some, and we lost some. So I want to counter the narrative that community banks were not hit by deposit outflows. We got hit suddenly very hard, but then we're able to stabilize, having relationship discussions with those that were not purely transactional. I'll leave it at that, other than to say that that moment did crystallize a lot of things in terms of efficiencies, in terms of what's most important, in making sure that we continued to guide our organization well through that disruption. But I do also want to applaud the federal regulators for the great work they've done getting to this point of making the first cut, of turning the corner, of taming inflation, we hope, and getting us back on a track where the comments that Lori Maley and Kathy Owen made in the 5 questions for 5 bankers in your CSBS survey, they really hit it on the nose on that inverted yield curve. You go and look at their responses, question 5 at the back of your programs, and you look at what Lori and Kathy were saying about the hit on community banks, and that's the wing of the party I'm representing here.
Well, as was mentioned, I think yesterday, is there this pressure to scale in this banking landscape today? I mean, can a bank just aspire to be a small bank and stay a small bank and live a happy life as a small bank?
Absolutely. Absolutely. Our business model had a path to scale some. You know, we're $5 billion in assets, which is it's still relatively small in the overall scheme of things. But I think of the 4,500 banks in our country, I think 3,500 of them are under $1 billion. You know, and so there's a lot of smaller banks, and I think smaller banks can be very, very successful. You hear, oh, you've got to be a certain size. I don't think that's the case. I think it's completely dependent on your business model and what you want to do. Ours, you know, when you're going into some larger markets, there's a certain size sometimes that you have to be to kind of get some earnings momentum up to where you can, you know, recruit commercial bankers, certain types of talent, things like that. So, but I think you can be in some smaller markets and still generate great returns and service those communities extremely well, and stay under $500 million. So I think you can absolutely have success being smaller. It is tougher. The cost of regulation comes down. The people costs continue to go up. Benefits costs go up. There are things that you have to do to try to keep pace. But I still think you can be successful smaller.
And Tom, you've been an independent bank forever. Do you feel any urge to scale?
As in M&A? We have a need to scale, which is what we've been building our infrastructure for the last 10 years.
Yep.
So there's a long list of capital improvements we've made to technology, to facilities, to our personnel programs, to be a $2 billion bank. So that's our next plateau, if you will, or our next threshold that we're aiming for, and we'll get there. So the need to scale is real. The costs are rising. Inflation is impacting not just the consumer, but the business, the enterprise, the bank. And you know, all you have to do is look at your healthcare bill to understand that one.
Right.
So we do have to scale, but we're not looking at this time for any outside integration activity in order to do it. We feel we're in good markets. We have good governance. We have good customer experience, good capital, good asset quality. It's not wood, but it looks like it. And we've got core principles that drive us to keep us dedicated to that independent path. Those are things that will pass off on what is another challenge right now, and that is the ultimate just rewards of we baby boomers. And succession planning is paramount. I think it's going to affect bank independence over the next 10 years. If people don't have that figured out, I don't think it will affect our institution because we do have it figured out, and we've been marching through it very deliberately this year.
I think that's a great point. I think when you look at the smaller banks, I think they can be successful, but can they recruit succession? I think it is. I think that's going to be a big topic over the next decade.
And Shaza, you're the newest among us.
I'm going to say I have a little bit of a different view on it. And the reason being, maybe it's our market in DC, or maybe when I was at Washington First Bank, it wasn't until we got scale that we became more attractive in the marketplace. We were able to attract people. We were able to attract investors. It just became a different story. And if you talk to the investment bankers, we are private right now, but at one point we'll probably go public. We keep hearing from them that the investors, the institutional investors, they don't want to look at small community banks that are teeny tiny. They want to look at community bankers that are having growth. So I'm going to say I aspire to be as big as Billy's bank, but you know, I think that we do need to scale up.
Let me add, and I agree with this. My comments on scale, I think it is. It's dependent on your strategy and your market. I know we've got in our state of Tennessee, where we're headquarters, we've got a lot of smaller banks that are family owned, sub-S, small, and there's a lot of those banks in the country. And I do think from a regulatory standpoint, I think we've got to figure out how to tailor regulation around those folks in order to help some of these smaller rural banks continue to thrive. You know, because in some of our markets, we have to have some scale to be able to bank certain clients or to attract certain types of talent. But there's a lot of smaller communities that really don't need that. They've got a good business model. They can make a nice return, but they also need to have, you know, they need a regulatory path that helps them ensure that longevity too.
Do you lose any of the humanity in this scaling up? I mean, we've been talking about relationship lending and the heart and soul of banking. Do you lose your soul?
I think it starts.
Gosh,
at the,
Brian, that's
it-
pretty
it-
deep.
I think-
That's really
I think
deep.
it starts at the top. I think if you truly believe in relationships and you continue to instill that throughout all your organization, you make that your culture of your organization, your sort of values. And I think if you do that, everybody's on board. I have a small little branch that doesn't have a drive-through, and the customer called my teller and said, "Oh gosh, I'm really in a hurry." And the person goes, "Well, I'll stand at the door and give you your money." I mean, people just do that. I don't ask them to do that. Or you know, if somebody can't get in till after hours, they wait for them. I don't ask them to do that, but they know that they're trying to help our community. They're trying to help the customer. And with that, they gain loyalty by that customer. And so I just think it's a culture.
Okay, all right. I overstated. Got a little too spiritual.
It's a great point. And I do think as banks get larger, I do think there is not necessarily that you sell your soul, but you know, to Shaz's point, I think smaller banks in particular are really built around people and culture. You know, at some point, and I think every bank's different, but there's at some point you become a little more siloed. You know, and I don't know if that number's 30 billion or 50 billion or something like that. But as you get into these regional bank sizes, things do feel a little bit different. There's some great regional banks. But they do feel different. But I think, you know, if you're under 20 billion, you can run a phenomenal community bank with a phenomenal culture that folks want to work in. Tom?
Well, I'm going to deflect the question as though we're in a debate, and I'm going to say what I want to say. I just want to applaud all the researchers in the room because reading these papers really demonstrates the rigor and probably the pain and the grueling hours and weeks and months ago without recognition. I had the pleasure of dining late yesterday in this conference center with Matthew Whitledge of Mississippi State University. And Matthew really impressed upon me. And he's a very modest guy. He'll not tell you he's the lead researcher in this group today. He partners with his good friend, Dr. Allen. But this conference that dedicates itself to really getting down into academic rigor to influence regulators and policymakers is really important. And we as community bankers have to applaud and appreciate how this conference comes together, how Carl White and Jim Fuchs and their great team have put this thing on. And I just want to thank all of you that do the hard work day in and day out because you care about the community banking space. And I think if I were to headline this entire conference, I would do it with two great quotes from Commonwealth University. Hannah Katia yesterday saying about community bankers, they walk the talk. And then the walk-away line of the week, Eric Shaw saying, great bank, go there. Terrible bank, don't go there.
Well, in the 10 minutes we have left, you know, the theme is looking to the future of the community bank business model. And so starting with you, Billy, and working our way in this direction, what is that future as you see it?
Yeah, you know, this is all I know. You know, this is I love this industry. You know, I love the people in this industry. You know, we've had great Where's Alan? Where's my regulator? Alan's in the back. I love my regulators, Alan. It's just we've just got so many positive things going on. Yeah, we've got some challenges and we've got some headwinds and there are things that are going on. But I think the future of community banking is really solid. I think I'm very bullish on it. We've got to figure out a way around some of these challenges and some of these headwinds, but we're resilient. And we'll do it. I do think there are things I mentioned, things like some of the regulation with 1071, 1033 with open access. That sounds great, but then I read a quote the other day from a top 10 bank CEO that says he's going to go take market share from the small banks because we can't afford the technology that they can afford. So there are some real things out there that some of this regulation, while may sound good in theory, in practicality it hurts us. So I'll echo what Tom said. This is great. This is the first time I've had exposure to this conference, and I really do as well appreciate the work that's going into trying to figure out how do we continue to keep community banking strong, because it's paramount to some of these communities that we're in. But yeah, I think we're set up for some challenges, but at the same time, I think we can get through those and still be very, very successful.
Tom, what's your crystal ball tell you?
Well, we are a mutual. There's a finite supply of capital. The only way we build it is through retained earnings. We need to get back to a yield curve that will allow community banks to generate reasonably modest net interest income to fund all of our operations and to bring something back to the capital account so that we can continue to invest in our communities and in all the critical operations, customer-facing business lines, and the great people that we're trying to attract and retain and build careers for in our company. So the future of the community banking business model rather is not uniform. We have a model, it's not the model. Billy has a model, it's not the model. Shaza has a model, it's not the model. That's a big takeaway from this conference. We're talking about standard deviations, and we're talking about the anomalies in the research, and that came through throughout this conference. So let's be aware of where those dots are as well, so that some banks are going to be in trouble for various reasons. Maybe they got too heavy in commercial real estate, and they got a little full of low interest rate loans over a certain duration. Other banks are going to thrive because they adhere to the lessons that we've been talking about the last couple of days, and that is true relationship lending, soft knowledge, soft skills, but really making it more of a science and a pattern of repeat behavior going up against the bigs. The community banks that do that, do it well and stay efficient, should be here for a long time to come.
Ajusa, Shaza.
Yeah, no, ditto. The one thing that I wanted to touch on, Tom just touched on it. I think in the next 12 to 18 months, we're going to see a lot of change in the office real estate lending, the big banks that have lent money to huge sort of office space buildings that are now vacant. People are working from home. They're leasing less space. Some people in the DC market started giving back their keys to their bankers. We haven't seen that yet because people have been paying the rent. But once their lease is up and they're not renewing, what's going to happen to those loans? And I'm going to say for us community bankers, be ready, because there's going to be a need to lend, and the big banks are not going to be out there lending because they're going to be dealing with all those big office buildings that they're trying to figure out how to dispose of them. So I think that there's definitely another sort of challenge that will be heading in the banking industry's way. But overall, I really, truly, I mean, this is the second bank I started, and and I believe that there's a need for the small to medium-sized businesses, anywhere from $1 million to $50 million in revenue, to have a small community banker that's going to be their partner to help them grow, to help them structure their deals, to help them sort of be able to realize what they're trying to do in their business. And without us, I think they'll get lost in a, you know, if one of our clients goes to the big bank and they're sent somewhere in Timbuktu to get it underwritten, they're not going to know who the client is or who the market is. There is a true need for the community bank to step up, and I think we'll be there.
Well, with that as our last word, I want to just thank you all for having a very spirited conversation about our future in the community bank business model. Ladies and gentlemen, Tom Levitt, Billy Carroll, Shaza Anderson, our community bankers today.
Thank you so much.